The worst thing that can happen to a beginning trader is not losing money. It's learning from the wrong people, because YouTube is gonna flood you with fake flexing, fake certainty, fake screenshots, rented lifestyles, and a bunch of smart sounding acronyms that make trading look way more complicated than it actually needs to be. One guy is telling you that this is the only strategy that works. Another guy is selling you some secret system, and you're sitting there wondering, what's actually real? What matters, and where the hell do I even start? So here's the truth. You don't need more noise, you need a simple framework to actually follow. So if you're tired of all the nonsense, tired of the flexing, and tired of wondering who actually knows what they're doing, this video is gonna be a great place to start. What we're gonna talk about today is one, the foundations, charting, psychology, trading system, your daily routine, and then the roadmap to bring that all together so you can create trading mastery for you to finally learn some proper ways to get started in trading. Now, first and foremost, what you're gonna want to figure out for yourself is, do you want to be a swing trader or do you want to be a day trader? On the surface level, most people think they want to become day traders. Very marketable. I used to do it all the time. I was full-time day trading for 7 years of my about 21, maybe more like 10. You know, it's, hey guys, I made fucking $5,000 in the first 15 minutes of the market open. Now I'm gonna go fuck off at the beach. Like, that is very marketable. And the reality is, it's not as realistic as most people think. Most day traders lose money. It's like literally 99% failure rate. Swing trading is what I do mostly now. It's how I began my career as a swing trader. Then I transitioned into day trading because it was more marketable for the business that I run. And now I've transitioned back into swing trading, and I'm way more profitable and making way more money swing trading. So let's just kind of break that down, what that all means and why that is for me personally. So what is swing trading versus day trading? A swing trader is someone that holds an asset such as Bitcoin or the S&P 500 or an individual stock like Tesla for over 1 day. It could be a week, it could be 2 days, it could be 2 months. That's basically just swing trading. A day trader is someone who is buying and selling within the same day. For me, typically when I used to day trade, I would typically only day trade the first 90 minutes of the market open of the US stock market exchange. And that kind of changed once I moved to Asia, and the US stock market are opening between 9:30 to 10:30 p.m. here in Indonesia, where I'm currently at right now. I bounce back and forth between Thailand and Indonesia. So it just didn't make a whole lot of sense to me. So what are the pros of swing trading? First and foremost is you have a higher win rate, a higher probability of winning over the course of the long term. The reason for that we can get into, but mostly it's because you're typically taking wider ranges for your stops because you're trading on daily or weekly time frames. So you have a lot more wiggle room to be correct on the next swing that's actually happening. And considering swings, you get to catch the big swings and the big moves in the market, especially when it comes to crypto or trading AI stocks. A lot of people are looking for that big swing, the multi-week run that you can take advantage of and make a lot of money. Another pro of this is you really only have to trade 1 day per week. What that means is I basically take 1 day, either Sunday or Monday, I analyze the market from the top down, look at all the setups, and then I find trap zones, areas where I basically set up if-then statements. If price gets into this zone, then I'll execute the trade. I set my stop loss, my entry, and my take profit levels all preset. Once I have set up the trade plan, even if the trade isn't live, everything else is on autopilot. Once the trade is live, it's on autopilot. The take profits are on autopilot, stop losses are on autopilot. I don't have to do anything after I set up the trade, and I only have to do that 1 day per week. Whereas if we look at day trading, you have to be at your computer every day. So let's just take a look at what the benefits and pros of day trading are. One is that it's very quick, satisfying profits. It sounds good, it feels good, it looks great for marketing if you're in a position like me where you're marketing education as well. Hey guys, again, I'm here in fucking Thailand and I made $10,000 this morning in 30 minutes and now I'm fucking chilling in my villa. Like, that's a great marketing story, you know? And it's also satisfying and gratifying when you actually do that. It feels very good, like, holy shit, I just made $10,000. The problem is, can you do that consistently? And by the end of the year, do you actually have any money in your account left? Or did you actually only do that a few times and felt great, and then you just burned through all your capital by the end of the year? The next pro is that there's no sleep anxiety. While it's still a little bit stressful, you can go to sleep stressed out because you had a bad day trading. If you're swing trading and you're holding, especially if you're over leveraged and you're not trading smartly with swing trading, every night you go to bed, it becomes a little bit more difficult to sleep because you're going to sleep, you're having nightmares about what your assets are going to do, especially when it comes to crypto. Everyone over leverages a lot of the time, especially in bull markets, because they're trying to get rich quick and they're thinking that this is the next bull run and they're going to change their life. Benefit of day trading is you're going to sleep with no risk because you closed out all your positions during the day. Also, you get a reset every day, right? Every day is a brand new day to make money. Now, that's beneficial because whatever happened yesterday, you can reflect on what happened and you can instantly start calibrating, okay, what I do wrong and how can I fix that today? But now let's talk about the actual cons or swing trading. As I just said before, it's much slower pace. So it's a bit boring. It requires a lot of patience and a lot of discipline to sit on your hands and do nothing for a lot of the time. And most people who are getting involved in trading, they want to be active. They want to not miss the next move. And I experienced this firsthand just by running an alert service, which was called the Wolf Pack. If I go silent because there's no swing trade setups and it sometimes takes weeks for these setups to come into fruition, people start canceling their memberships. And then that turned into me trying to find opportunities just to keep people active, just to keep people excited. And that's just simply not the best way to trade. When it comes to swing trading, you should be looking for A+ setups only. I'll show you into my accounts at the end of this where I have an 89% and a 75% win rate, which is extremely good for a trader to have. And that comes from patience, from not doing anything a lot of the time and only taking A+ setup. You also have lower profit margins. If you're trading a weekly or daily time zone, and let's say you have a $10,000 account, okay, and you're risking 10% per trade, which is way too high of a risk, but just for an example for math, that means if you were taking a 2-to-1 risk reward trade and it might take 2 weeks for that profit target to hit or the stop loss to get hit, that means you're gonna risk $1,000 to make $2,000. So that can take a long time with a lower profit margin. Whereas if you're day trading with the same size account and you're looking for a 2-to-1 trade risk today, you can make $2,000 today while still risking the same $1,000. That sounds amazing on paper, and that's why day trading is much more appealing on the surface level to most people, because it sounds like getting rich quick. And what do most people want? Get rich quick. Guess what? Newsflash, there's no such thing as getting rich quick. The only people that get rich in this game are the people who get rich slow, which is why swing trading is much more profitable for the majority of people who are participating in the markets. What are the cons of day trading? One, you have a low probability of long-term success and your win rate is going to be much lower because you're becoming much more active in your trades. You're reacting a lot of times in real time on emotion, and the more that you're trading on emotion in real time, if you're trading such as the market open like I used to do, within the first 90 minutes. A lot of times things happen very quickly and it's easy to react on emotion as opposed to a full trading system that's just kind of a set and forget system. So you're gonna be winning less and taking more losses overall, which is extremely difficult to manage just mentally in general. Most people will come back to the trading station and sit there and try to make that money back and revenge trade it, which typically doesn't turn out in the right way and they end up losing more. And that just turns into a death spiral and they lose all their money. Another con is you're stuck to your computer, right? You have to be there for the stock market open at all times. And also it's time zone dependent, of which swing trading is not. So just for an example, day trading is not freedom in my opinion. And the reason for that is because when you're day trading, you're typically trading the market opens of either US, London, or Asia, which means you have to be at a specific place at a specific time 5 days a week. You literally have a boss and you have to clock in Monday through Friday. I don't call that freedom. That's also why I quit day trading. I quit trading for 2 years in 2018 and it was very, very depressing. And to the point where I got into crypto in 2019 because it was 24/7 time zone dependent, and I started swing trading again, which was actually my core strategy, the Fous when I launched that product in 2010, which was swing trading strategy. I took those core principles, migrated it into crypto, and began swing trading in a 24/7 market where I didn't have to care about market opens at all. Just before that, you can see here, made $210,000 longing AVAX. Just before that, you can see my actual trade here inside of my Femix account, of which I trade at Blowfin now. A lot of big trades that came into fruition. So this is the $237,000 profit Bitcoin. You can see these were the actual profits, 54,000 on Bitcoin, and then I had a bunch of others. And then we've made an additional $109,000 on my Blowfin account, like a 75% win rate since January 1st. It's important to note that these are on actual accounts, and I'll talk about this later in the end of this video. I'll give you a little bonus about how to spot fake traders that are trading on like MT5, Trade Locker. It's ridiculous what's going on. I feel like I should make it a full other video discussing that topic, but nobody's actually showing their actual results, and it's a big, big problem in the trading industry. At the end of the day, for me, in my personal experience of doing this for 20 years and being a day trader and swing trader, Swing trading is more profitable and it's lower stress and it gives you more inner peace. Let's talk about the probability of win rates and why it's better as a swing trader, or why you have a higher win rate as a swing trader versus a day trader. And all this boils down to trading high time frames versus lower time frames. And if we look at this kind of diagram here, if you're trading on the weekly zone, you essentially have a lot of wiggle room between the high and the low of that zone. Say if you're trading, let's just say this is a demand zone that you're trading, your entry would be up here, your stop would be slightly below. You have a lot of wiggle room to play around here where you don't get stopped out and you allow price to come into this zone. However deep it may go, you don't know where price is gonna bottom out, but it allows you a lot of wiggle room to buy into that zone and then hopefully profit when price exits that zone. But the more and more you drop down into time frames, such as the daily zone here, now your room for error gets smaller. Then you maybe go to the 4-hour zone. Your room for error gets even smaller. Then you go to the 1-hour zone. Your room for error gets even smaller. And we can open up a chart just to kind of take a look at this. Gold had a nice little setup here recently. For example, this weekly zone where price dipped right into, you can see there's quite a wide range for you to actually, from the top of the range, 4,100 to 3,989. That's a lot of room. Let's say you had a stop, you entered along, your stop just below. Let's say you wanted to take the profit here at 4,600. 2.93 risk reward on that trade. So if you risked $1,000, you're gonna make about $2,900 on that trade. Wide stop. You have a lot of wiggle room there to not get stopped out and allow price to come anywhere in that zone and actually trade it. Let's say we drop down to the daily chart and try to look for a zone inside of here, which inside of this zone, we kind of have this profit target, this zone right here, between this range here. In this case, you might have not even got filled because it just barely tapped the top of that actual zone. But let's say you did, and you put your long entry here and just below, let's say, same profit target, but you were pushing your time frame down to be more precise, you'd earn about $5,600, a 5.69 ratio to losing $1,000. In this case, we're gonna be a little bit more wider in your stop. You're gonna earn less money, but you're gonna reduce the probability that you will take a loss because you're taking a wider zone. Now, the other caveat to this is maybe if your entry wasn't like just at the top of this, the reality is since you didn't take a wider zone, you might not even catch the trade at all. So the wider zone ensures participation and it ensures the less probability that you're gonna get stopped out. The more you condense your time frame for entry, the less likely you're gonna actually even enter and participate in the trade, and the more likely you will actually get stopped out because you're taking a much smaller zone. Now let's take a look at the 4-hour chart. At this point, we're trying to get into kind of sniper entries. Maybe this is the 4-hour zone within the weekly zone that you would want to look at, maybe right here. And this is why day trading starts to look way more appealing, because if you catch these moves, your profit margins get very, very high. Now let's take a look. If that price came into that zone and you got your sniper long here, stop just below that zone, same profit target because we're going for the same move. Now you have a 16 to 1 risk reward ratio. So for risking $1,000, you would earn $16,000. But the probability of you getting into that actual trade, one, you wouldn't even participated in this move because price never got into that zone. And because this range is so small, the probability of you getting into that zone and potentially even just getting flushed out reduces the chance of you even participating because you may have just entered, stopped out, then price bounced, and now you're then revenge trading it, chasing it up here, and increasing your emotions, increasing the chance of you fucking up and just turning what could have just been a very casual, awesome trade, taking a higher time frame. You get in, wide stop, get out for profit, very low stress, lower profit margin of 3 to 1. You went for the 16 to 1 because that's what the YouTuber talked to you about. And he showed you one example of him hitting it. And now you're the fucking guy trying to get in here, getting stopped out, and then you're chasing it all the way up here, 4 losses, and then now you just burn through your entire fucking account. That is the reality of day trading for most people. So when we look at swing trading, higher time frame, you have a higher win rate, lower stress, lower profit margin, but you get a get rich slow over the long term. All right, you actually get to grow your fucking account. If you're day trading, you're trading on lower time frames, you're gonna have a lower win rate, lower probability of success. That might also be true because you're fucking broke now. You might also, well, you will be much more high stressed, but you're gonna have these high margins, high risk, high dopamine, excitement trades going on that happen every so often, but also with a fuckload of losing. And this is more likely in the long term that you're gonna burn up your account and be the statistics of 98% of traders who are never making money. So most people think that day trading is the answer, and the reality is that most fail and are short-lived, it reaches burnout. And swing trading, for me, that I have noticed in my own personal experience, that it allows a lot more longevity, freedom, and sustainability to actually grow your account over the long term. So let's talk about candlestick charts here. If you don't know what a candlestick is, Basically, when you're looking at a candle, this is called the body, and the upper and lower parts of that candle is called the wick. If we're looking at a green candle or an up candle, sometimes it's white as well, the lower boundary of the body is the opening price. The top boundary of the candle is the close price. And the high of the wick and the lower of the wick are basically just the lowest price of the candle made that day. So the open, the close, the high, and the low. Now on a red candle, the opening price is the top of the body. The closing price for that candle is the lower end of the body. The lowest wick is the lowest price of the session, and the highest wick is the highest price of the session. So how that would look if you're looking at a 1-day time frame, which on a 1-day time frame, those candles last for 24 hours. So this candle right here tells its story, okay? And when you're looking at a daily time frame, there's a bunch of those candles all lined together and they tell a story. If you want to drop to a lower time frame, all that is this 1-day time frame also has this internal story inside of it. Just for an example, on a 4-hour time frame, that's 6 candles, right? And so basically what it would look like is, okay, price opened here. As we can see, price opened here on the daily, and also on the 4-hour, price opened right here. Came up, the low of the 4-hour chart showed a low right here. The high showed a high right here, and then the closing price on the 4-hour time frame closed right here, and that makes up the daily candle. Now there's different types of candles that are extremely important to understand. There's balanced candlesticks and there's imbalanced candlesticks, and these are kind of the core engine of how you read supply and demand. Balanced candles are basically when buyers and sellers are neutral. Basically, there isn't any decision yet of where price should be going, and these are typically doji or shooting star candles. Dojis are very small bodies with upper and lower extended wicks, as we can see here. A hammer candle is usually a reversal candle where price is coming in from the bearish side and then reverses to the upside on that. And you can see the opening price and closing price are typically the same. And during that session, price came all the way down, and then buyers came in and pushed it all the way back up to close near its opening price. That's typically the sign that sellers were rejected, new buyers came in, pushed price up. That hammer candle is typically, statistically, I don't know how relevant it is, but that's what definition-wise is typically a bullish reversal candle. Alternatively is a shooting star, same concept. Price is typically coming in a bullish formation. Price got pushed up at the opening price. Sellers came in, buyers rejected that higher price. Price comes back down and closes near the opening price, and typically that's a sign of a reversal off that candle. Imbalanced candles are when buyers or sellers increasingly take over and you see a strong body candle, either to the upside or downside, where the body is much larger than the actual wicks, okay? These are powerful, strong candles indicating directional movement, either bullish or bearish. So when we look at this on a bit more better illustration, you might see imbalanced bullish candles coming into fruition here. Then you'll see balanced candles where price is a little bit sideways. You'll see dojis, very small candles that don't really have a lot of powerful movement to the upside or downside. And you might see something like a bullish flag, and that's balanced price action before an imbalance came in and price pushed out. This means that buyers and institutions are now back in control of this trend, and price is likely going to continue up in a bullish trend. Now, a reversal indication is prices of imbalanced candles coming in very strong, bulls are in control. Then we see prices kind of halt out. Now, at this point, the momentum is now losing steam, and you might see some doji candles form up and then a bearish shooting star where prices pump to the upside, were rejected, come back down to the closing price, and then as soon as the lows are taken out, a strong imbalanced candle of sellers. This is likely that there is going to be strong continuation to the downside and a potential reversal that's just getting started, and this bullish trend that was forming up here is now over and the trend is now reversing to the downside. So it's important to understand the difference between balanced and imbalanced candles. Now let's talk about support and resistance and the concepts of this. Now there's the classical method, which I was kind of brought up learning when I started in 2005, 21 years ago. This is just like the classical technical analysis. Read a book on trend lines, support and resistance. It's kind of a self-fulfilling prophecy. Then there's the institutional method, which is based on liquidity and supply and demand of where the big players getting in and out, and where are they going to defend their positions. We'll get into both, but we'll start with kind of the traditional method of supply and demand, support and resistance based on the self-fulfilling prophecy. And it's essentially where our beliefs influence our expectations influence our behavior, and our behavior influences results or price action. This is the self-fulfilling prophecy of support and resistance. So when it comes to support and resistance, you might see a low that is formed in price action. Now, the belief is that if price returns to this zone, it will be met with buyers that will bounce off this level, and that will create a horizontal support line. If price comes up off that level, now there's resistance. Now that we have the belief that this is potentially a support zone, what is our expectations? Our expectations is that maybe we should be buying in that zone, and maybe buyers are going to come in. So now as price reaches that level, it influences our behavior, AKA we start buying in this zone, AKA as a whole and a neural network of all market participants, the behavior and expectation is that we will buy in this zone. And then there's a result of that behavior where price bounces off that zone. And now you have a support zone that you see time and time again come up. Again, that would be the same exact reason why price would maybe bounce off this high, and then you have a horizontal channel due to the self-fulfilling prophecy. Now, when you're looking at these zones breaking, essentially, the more and more times that these levels are retested, I think of it as the analogy of a brick wall, and every time it's tapped into these zones, it's like someone taking a hammer and smashing the wall. It's compromising that wall and showing cracks in the wall. And the more and more you take a hammer to that wall, the more and more the likely it's going to get broken through because it is now compromised and it's no longer strong. So typically 2 points here are going to indicate an area of support. And maybe the third, it's like, okay, this is now getting a little bit tricky. Fourth, then you're looking like, okay, this thing is going to bust through. And maybe you can turn that into a trade or even anticipate it, get short up here for the eventual breakdown, and vice versa to the upside. So that's kind of the traditional way of looking at support and resistance. If we look at supply and demand zone, this is more so looking at areas of balance and imbalance. When we're seeing areas of imbalance or balance like we see here, and then a huge amount of sellers that push price out of that level with an imbalanced strength candle, what the logic tells you is that the only players who have enough money and power to influence price this big are institutions. And what we can expect is that if price returns to that zone, these institutions who now have got into that zone are waiting for price to get back. Now, obviously, where they had likely not gotten their full position. And on top of that, they want to defend their position. So they will add more shorts as price comes back into this zone and start selling. For us as traders, we can't predict that this will happen. So what you do when you're looking at supply and demand zones is now this becomes an area of edge for you, where if you're looking at, say, if this was a bearish market structure, break down here, now our plan of attack is not to predict that this is going to happen. It would be to short as we come back up into supply for the anticipation that these institutional players will defend that price action, and then price will push back down into this zone. That is the same thing for here. Now this, for example, let's just say that this was actually bullish price action coming in here. Price came in. We have an area of balanced candles with strong institutional buying pressure that came out. Coming back up in here, where would we want to buy? We don't want to buy into the momentum here. We want to wait for price to come all the way back down into here because we can anticipate and theorize that these people who have bought into this, institutions revealed their footprint. As price comes back in here, they will defend and they will re-enter into the position that will influence price to come back up and probably break these highs. And then we can start exiting for profits when price gets above those highs. So what retail traders do is they buy up here and then they stop loss down here, okay? That is the exact opposite logic and framework that we need to be doing. The playbook for me, and this is something that a lot of traders struggle with, but why I don't trade often and why a lot of my time is sitting on my hands is that there is something called the gray zone. And typically this is areas of where there's imbalanced candles pushing price up and down. And that typically is the area where retail traders are FOMOing in to these positions. And price hangs out in that gray area probably about 90% of the time. And those areas are where I do absolutely nothing because I have no edge. I can't predict what the hell is going to happen. For me, the only time I trades and execute are in these windows of opportunity where I know retail traders are stopping out here on their shorts, or I enter here in this zone where price probably spends 5% of the time. And I know traders who have been longing momentum, they're going to stop out down here and I'm going to be buying into their stops. Okay. So there's small windows of opportunity where price basically in those two zones, it only spends about 10% of its time total. And 90% of the time of price action is spent within the gray zone. Now let's talk about market structure. Okay, so there's bullish market structure and bearish market structure. All this basically is higher highs and higher lows in a continuation of price in that same repeated pattern until it no longer repeats that pattern, right? We have a low, then we have a high, a lower high, a higher high, lower high, higher high, and every time it takes out these highs, it's called a break of structure. And that's continued to be a bullish trend or bullish market structure as long as that continues to go. But as soon as that break of structure happens and we create a higher high and the most recent lower low below the 2 points of the last higher high in the break of structure is now breached, this is what we call a change of character. And if you're looking at an asset that essentially has been in an extended bullish market structure, when this happens, this is a clear telltale sign of a potential reversal. And at that point, you don't start shorting down here like retail or getting stopped out, right? You wait for price to come back up into the supply zone, and then you start shorting here for the next leg down. And I can show you some examples of when we traded this setup right here, making $237,000 on Bitcoin and all these assets. We can take a look at how this looked because we also shorted Ethereum. I think the Ethereum example might be a little bit better. Just taking a look at market structure. What do we have here? We had a break of structure. Again, what do we have here? A break of structure over those highs, right? Higher highs, lower highs, higher highs, lower highs, higher highs, continuation of market structure, okay? Until when this low is taken out, what is that? That is now a change of character based on this exact framework, where if price is extended and you see that reversal, now that's a change of character. So we don't want to short down here, okay? What we want to do is wait for price to get back into supply zone. And what did price do? Dump back into supply zone. Then we saw the biggest liquidation event in crypto history. And that is when I made $250,000 simply by following this simple market structure, extended price action, reversal framework, getting short 250K. While everyone else was FOMOing max long, thinking that the crypto bull run is here to stay. We are gonna fuck it. Like, do you know how many people, retail traders, start buying in here thinking that this is gonna be an ATH run? The majority of market participants. That's why it was the biggest liquidation event in crypto history. Crypto exchanges probably lost 50% of their clientele base on this move because there was so much FOMO, so much get-rich-quick fantasy that no one wanted to believe that the bull run was over. The same thing happened here on BTC. What happened here was actually a velocity trap, which we can talk about next, but we did have the bearish market structure change of character right here, okay? Now it did go extended to the upside, but on an extremely high velocity move, and that's what we call a bull trap right there. And that's where I got short right here on BTC and took advantage of that massive dump to the downside. We can even look at my trade alerts. But it's just important to understand these frameworks that a lot of times are very simple. Now there's a lot more that goes into trading than just that, but understanding these things is extremely important just to have the basic knowledge of how price action works. So you can see here, October 9th, 9:02 a.m., short Bitcoin, 2% retesting a dump trigger, next stop daily demand, major bull trap at ATH here. You can see price action here. As soon as that came in to this level, have that nice exit candle of imbalance after a couple of balance candles. That was my first indication to the downside. If price came back up and retested that zone, I'm gonna get short for the push down to the next daily demand. Price got way lower than that. We saw the massive liquidation event. My exit was right around this zone here. It dropped way lower than that. So I missed out on a lot of profits, which then led to a lot more downside because that shifted into now bearish market structure, which is why we have seen continuation of bearish market structure all the way down, of which we shorted right here, made 90 grand on that move because it's a continuation of bearish market structure. Most people didn't want to accept that and continue to trade bullish market structure. So same thing goes for bearish market structure. You continue to see lows, then a lower high, then a lower low, lower high with breaks of structure, break of structure, lower low, until eventually that most recent lower high is then taken out. And then that creates a change of character, which now potentially means you want to buy into the dip, into the demand zone, because if you're looking at supply and demand, institutions likely were responsible for this push right here. If that actually broke this high and had a lot of momentum, they will defend their positions because they don't want to take a loss. They're very powerful. They want to make money. So we want to follow in their footprint because now they have left a footprint here. We want to buy into that demand zone in the consideration that it's now potentially bullish market structure in the making. We don't know for certain, but it gives us the opportunity to set up a trade plan based on that framework. That is essentially market structure. And if you're looking at like traditional technical analysis of like ascending trend lines and ascending channels, like basically what is that? It's this lower highs, higher highs until the trend breaks, then we have a break of structure or a change of character, market structure flipping. It's just a different way of looking at ascending channels and descending channels, which that was more so what I learned when I was getting started in 2005. So let's take a look at breakouts versus market structure, AKA velocity traps versus compression. A velocity trap is typically, it can be part of market structure. It's something that you need to take note of, and it's something that I took note of on the breakout of BTC at all-time highs. If you're looking at a breakout that could potentially be something you actually want to trade, you would see a resistance level made, price come up, test that level, and then make a lower high, and now you have an ascending trend, and then price retests again, another lower high, and it creates compression. Now, these are breakouts that you can actually trade if the market conditions are right. And if you anticipate it, you can get in and then rip it to the upside and take advantage. I'll show you an example of AVEX that we talked about a little bit ago, making $210,000 on this exact setup on a revival pattern where the lead-in trend is bearish. But if we look at breakouts of resistance or supply, whatever you want to call it, and price has no compression and it just rips straight up through that zone, it's likely going to be short-lived because it happens so fast in a high velocity manner. And then all of a sudden, as soon as that price goes back under this level, now everyone who had longed up here, all their stops are just going to get cooked and price just instantly drops. And that's very dangerous to be part of if you're trying to buy in breakouts. So it's important to understand the difference. How I spotted BTC and ETH, crush it short. We just talked about that. Break of structure, short into supply, then the massive dump. This is also the same situation that we just talked about on AVEX, of which I totally forgot that I drew this illustration. But just to give you an example of how that trade on AVEX came into fruition is one, we had the lead-in trend followed by the compression triangle forming. Now, when I see this compression forming up, I'm not waiting to buy up here. Now, back in 2005, maybe I would because price action was working that way. But for me, what I like to do is after that first initial bottom, and typically see a strong reaction after that, then you're gonna see areas of balanced candles here, followed by areas of imbalanced exit candles that retest the upper zone. So what that means is now you have a demand zone that you can draw to potentially be buying into these levels, and then you can start scaling into those zones. So now you have a nice solid risk reward ratio where maybe your entry is up here, your stop is down here, and now your entry is here, and now you have this box of wiggle room for your loss. And then if we take that, loss, same calculation, you now have a risk reward ratio of losing 1 here, then 1, 2, 3, 4. Now you have a 4-to-1 risk reward ratio for the profit target up here, as opposed to people who are chasing the FOMO up here. Where do you even put your stop? I have no fucking idea. If you do it down here, you're basically at like a negative risk reward. So I wait for price to come down into these golden zones so I can get a strong risk reward and take advantage of the breakout to the upside. And sometimes these breakouts, and they turn into nothingness, and I can still make money or stop out for break even. Whereas people who bought in the breakout and it turns into a failed breakout, they get absolutely cooked. And that's why a lot of these things, if they don't work out, have a very fast acceleration selling to the downside. If we look at the psychology of trading, it's extremely important that you have a rule-based trading system. And within those rule-based trading systems, you have trade setups and risk management rules. Once you have that trading system, now you have to see if you can manage that in the real market. But if you don't have trading setups and a rule-based risk management system, and you try to go straight from here into the market, or basically bypass this as just a bystander over here and go straight into live market chaos, which most people do, you're gonna get absolutely fucking cooked. So it's important that you build a trading setup, trade system that has trade setups and risk management rules before you ever enter the market. And then hopefully once you're in that live market chaos, there's gonna be a lot of external factors that come into play that can fuck up your entire trading plan. So when it comes to trading psychology, first you need a trading system, and then you need to figure out how to have inner peace in your life so you can actually follow the rules of your trading system. Anything you can do to calm your nervous system so you can make rational decisions. It's this psychology leads to your trading patterns that you actually trade. What A+ setups do you look at? Then you have your entry and exit rules, then you have your risk rules, and that is what creates a trading system. So if you look at any sort of setup, first you have to have your trading pattern, and it must pass a definition of what consists of this pattern. For me, when I look at a revival pattern, the lead-in trend has to be bearish. We have to have at least 2 tops at a resistance point where you can clearly draw the horizontal line. We have to have at least 2 taps at higher lows. And also, I do not want to enter anywhere except for the third, at least second or third retest into a demand zone. That's a little bit of entry rules and criteria definition rules for when it comes into actually executing that trade and me wanting to take part of it. So when it comes to risk rules, there's two different frameworks that I personally use depending on if you are self-funded or a prop-funded trader. When it comes to self-funded trading in my own personal account, like that I trade at with Blowfin, I never risk more than 2% per trade. That means that, let's say if the account was $100,000, that means if my entry's here and my stop loss is here, if my stop loss is hit on this trade, I cannot lose more than 2K on this trade. So what that means is my entry here and my stop loss here, that should determine my calculation size for my account of how many shares or coins of this asset can I buy. If I'm trading on a prop funded account, I usually risk no more than 0.8% per trade, because when you're on a prop firm account, typically you have a max drawdown of anywhere between 4 to 10%, depending on the actual prop firm that you're trading. So you don't want to instantly blow this account up on a few bad trades. With a trade on 0.8% on say a 200K account, depending on what your drawdown is, that'll give you about a 12 loss streak. So you could lose 12 trades in a row before you would lose that actual account. I believe that was based on an 8% drawdown. So that's what it would look like on that. If you had a 200K funded account, you would be risking $1,600 to make $3,200 if you were doing a 2-to-1 risk reward ratio trade. If you're following that model, you can lose 12 times in a row before you actually lose that prop funded account. So at the end of the day, guys, you need to keep your daily life structured to reduce stress, stick to the fucking plan, and don't fuck up and change it later, add more risk, or come in and move your stops lower to increase your loss size later. Next up is your daily routine. As a day trader versus a swing trader, typically you're gonna do top-down analysis. When it comes to me, when I'm looking at assets, what would I do? I'd come in here on Bitcoin and I would look at first, maybe monthly demand zones. I would draw out potentially monthly demand zones or supply zones as well. Okay, so this would kind of be monthly supply. Kind of the next major monthly demand is down here. And then we kind of just break it down from there. Where's the next relative weekly demand here? We actually can compress this into this one, of which that turned into a nice dip buying opportunity on BTC. Even on the weekly here, this is weekly supply. And at this point, I just keep kind of boiling it down into monthly, weekly, daily. And all that does is creates opportunities for me to find those zones of opportunity. Remember, like I said before, a lot of the time, price is gonna be in like gray zone territory in here. I don't wanna execute in here. I wanna execute somewhere down here or somewhere up here. So that's the purpose of kind of finding your windows of opportunity, is mapping out higher time frame demand and supply zones so you can find where those windows of opportunity are and identify where the gray zone is that you don't want to be participating in. That's essentially in a nutshell of what you want to do as a day trader and a swing trader. So if you're day trading, you're going to be doing that every day for much smaller time frames. As a swing trader, I do that 1 day per week, typically on a Sunday or a Monday. Daily rituals. Everything is here is mental optimization focused. Hitting the gym, optimize your body and mind, it finds more confidence, the stress reduction. Sauna is great for regulating your nervous system and reducing stress, also improving sleep. Your sleep is extremely important when it comes to trading. You wanna be operating at peak mental capacity. Also, you wanna eat clean. Some of you might not be considering that as a factor, but I know if you eat clean, at least for me, in my experience, you do feel better, okay? You wake up more optimized. You don't feel puffy, you don't feel bloated. If I go have fucking pizza on a Sunday after a night out of drinking, the next day I'm fucking like bloated, face is puffy, clouded mind, okay? So it definitely makes a massive difference. Also, reduce toxic relationships. The easiest way to know what a toxic relationship is if your interactions with that person is draining as opposed to uplifting. You all know who those people are. You have those people that when you interact with that person, you walk away drained. You walk away thinking, okay, I need to fucking break from this person. Oh, or thank God I'm fucking done with that conversation. Yes, some of those people are just in your life and you can't get rid of them, but try as much as possible to only be around people who fuel you, people who lift you up. Clean up your Instagram and TikTok and Twitter algo. If you're constantly consuming political content all day, which I know most of you guys are, triggering yourself, getting like picking side of left versus right, none of that is gonna serve you in the long run for your life. It's okay to have an opinion, but if you're consuming that content all the time, you're gonna constantly be agitated, cortisol always be high, constantly pissed off, underlying somewhere scale, and that is definitely gonna bleed into your rational decision making when it comes to trading. Here is the roadmap, and I'm also gonna show you how to spot a fake guru in 60 seconds. So the first thing you're gonna wanna do is pick a mentor. And at that point, you're either going to watch free content or invest in your education. So if you do free content, right, your time to mastery is going to take years. Time to profitability, probably 2 to 4 years. And you're also going to lose a lot of money on the way because you're going to have to pay market tuition. Market tuition is basically the market humbling you because you don't know what the hell you're doing. And you're actually depositing money on brokers, losing it all, and that's your part of your education. Time to mastery, if you invest in a good education, is about 90 days. But just because you have the framework and the knowledge of a framework doesn't mean you're profitable. It just means you understand the system. Time to profitability, maybe 6 to 12 months. It can totally vary from person to person, and it depends on if you have mastered the psychological part of it and actually got your shit together and could actually execute what you learned in that system. Some people, they can learn how to do things, but they can't click buy and sell when they need to. They can't operate with discipline and have the patience to wait for A+ setups, or they react after losing trades, revenge trade, and just blow it all up anyways. So with that, the puzzle is already done for you and you get continued guidance inside of a mentorship program. If you're doing on your own free content, you have to put the puzzle together yourself, and you have no idea if you're even on the right path because no one else is there guiding you. And you're probably also watching free content from like 10 different YouTubers. You don't know who to listen to or what's actually going on because you don't know how to actually put it all together because you're inputting a lot of different factors and different strategies. Next thing you want to do is pick a broker, and you either are going to choose between a prop firm funded trading account or a self-funded trading account. Now, right now I'm doing kind of a combination of both. So what's the difference and the benefits of doing either one? One, with a prop firm, it's a very low entry cost to get in. You don't have to risk your own capital. You get higher trading capital. 75% of traders are trading with under 25K, which creates a big problem to make any sort of relevant income to add to your overall income if you're trying to use this money to live your life as well. You get higher trading capital, bigger profits, lower risk. If you're a self-funded account, it's high entry costs, low trading capital, smaller profits, and higher risk. Let's say you have $10,000 trading capital set aside right now to work with. If you wanted to go to a prop firm and let's say trade with a 100K account or a 200K account, that might cost you somewhere between $500 to $2,000, depending on where you're actually trading at. Hide your funding, we have recently switched to instant only. There's no more challenges. We're typically, like if you look at this account here, this is a one-step challenge account. This is a 500K challenge account. I had to earn $60,000 on this account first in a challenge environment to prove that I'm profitable before I could get access to live capital, of which now I'm up on this account $26,000, and I am eligible to receive $23,000 because I earned 90% of the actual payout. I just have not requested it yet because I have not reached the best day rule, of which I have to make an additional $1,000 to reach that rule, and I'm eligible to reach my $26,000 in payouts. Let's just take an example. If you had 10K in trading capital, if you wanted to do self-funded like I do on Blowfin, you would be depositing probably that $10,000 bag because you're like, well, I'm going to use all this money because the more I'm trading with, the more money I can make. Problem with that is you now have a 10K account and you're getting one chance to win at trading. And honestly, it doesn't matter who you go through a mentorship with, me, anybody else, the likelihood of you being successful on your first trading account is very, very low. It's very likely that you're going to blow up your first trading account because yes, I can teach you the exact way I trade, and I can even alert you of all my trades that I'm entering and tell you when I'm getting in, when I'm getting out, sending you out if-then statements, telling you weeks in advance sometimes before I even enter this setup. That doesn't matter. You are going to be tempted to break the rules of the system, and you're going to have emotion that you need to go through the experience of first to understand. You need to be slapped on the wrist. Say, you can't do that, because if you do, you're going to lose. And it's likely that you're going to push those boundaries until you get slapped, AKA lose money. You're going to pay market tuition. Doing this is very, very high risk because you are risking all of this at one time. If you go to a prop firm account, you don't have to trade with your 10K capital. You could say risk $500, you get a 50 to 100 or 200K account to start practicing with. And if you do pass a challenge, or if you're at Hydra and get instant funding and you earn payouts, you maybe only risked $500 to start actually making money. And it puts you in an environment with forced risk management rules that if you break those risk management rules, you get banned from that account anyways, and you have to start over. So on a 100K account, let's say it costs $500 to take that challenge or get instant funding, you could lose 20 accounts at $500 before you lose your entire $10,000. So you would get 20 chances to learn the rules of trading before you would lose everything. That gives you a much higher probability of actually finding long-term success by giving yourself the opportunity to learn in an environment that is one, forced risk management, and two, not risking all your capital up front. What's the bonus here, guys? How to spot a fake guru. Okay, one, do they sell a course? Scammer, not true. That's where most people think all these traders are scamming, just because people don't like the fact that people are making a lot of money trading courses. For example, my best year trading was the 2022 bull market. I made like $1.7 million. That year, I sold about $5 million plus in trading courses, okay? That's just the reality. A lot of times you're gonna make more money with education because you can scale it higher than a lot of times than you can with your trading profits, okay? That has nothing to do with spotting a fake guru, okay? It doesn't matter what industry you're in. If you look at the alternative to learning a topic, you can go to college for 4 years, spend $40,000 and learn generic bullshit that has nothing to do with anything meaningful in your life or how to make income or learn a real skill. I dropped out of school my senior year of college to go all in on trading. And I didn't learn shit in college. And I'm sure if you have been in college before, you also know that you don't learn a whole lot of useful life skills that are gonna help you earn money. You're gonna learn how to connect with humans because that's what you do mostly in college is you party, you talk to people, you meet people, and those are all very important life skills. But the reality is if you go into the job workforce, you then get retrained on how to do that job. You don't learn how to do any job inside of school. So courses are a framework to learn a skill set in any industry, hopefully by someone that knows what they're talking about. Obviously, there's a lot of grifters out there who don't know what they're talking about, or maybe don't really have a whole lot of experience. I've been doing this for 21 years, so I excel in the extent of time in this game of learning. So I have that advantage over a lot of these like 20-year-old fucking trading influencers that are very good marketers. They're very entertaining, and I understand why a lot of people watch and consume their content. I myself do as well. They seem like funny, cool guys on the surface, and I'm sure if I met them, I'd probably get along with them. But what most people don't understand is the reality of what is actually happening behind the scenes and the fake stories they are telling to then not only sell courses, but also earn money by doing something extremely shady. It all boils down to where do they trade and who do they promote? Because if you look at trading, nobody needs a course to start trading. But what do people actually need to start trading? They need a broker, a place to execute trades. And when you look at the statistics of 95 to 98% of traders failing, those are all deposits. 98 to 95% of all deposits going on to brokers end up going somewhere, and it's not to those traders. So where does all that money go? It goes to these traders who are either secretly owners of these brokers or a high tier affiliate of these brokers. And I'll tell you why this is a very, very real problem. First of all, spotting a real trader. Are they trading on prop firms that they're not affiliated with, showing actual payouts? Regulated stock exchanges, with their trading at like Interactive Brokers or TradeStation, those are people who are trading on real trading accounts. And if they're showing, of which I think some guy just got caught photoshopping some of his trades, of which why I'm actually showing you inside the actual account here. You can see all my trades here, 89%. This is my actual Blowfin account. You can see Bitcoin ever since January 1st, I switched to Blowfin at the beginning of this year. Prior to that, I was FTMO Femex, which you can see all the trades when I traded this. These are all screenshots from my actual trades at Femex. Prior to that, even here, this is showing my Femex account, showing what my position size was, where everything else getting in, getting out. That was cashing in 210K, of which this was up 240K at the time. I eventually closed it out for a $210,000 profit. Also, if they're trading at a crypto broker or they're trading at a regulated futures exchange, some traders actually trade at that, which is actually real order flow, real trading activity on a centralized order book where you can actually see live trades. Going into spotting fake traders, the biggest red flag that you will ever see to spot a fake trader is, are they trading on MT5? MT5, while in itself is not a scam product, it's actually a robust trading product that can be used on a real broker to actually trade products and actually trade assets. The likelihood of the trader that you're following is using a real broker that's not an offshore B-book broker is very unlikely, and it's almost slim to none, and I'll show you exactly how to identify this in 60 seconds. What is a B-book CFD offshore broker? CFD stands for contract for difference, and if a lot of them are trading, they originally started kind of like with Forex trading, and Forex trading is real. one of the biggest markets, if not the biggest market in the world. And that's all institutional order flow, real transactions going down. Now, an offshore B-book broker is basically sets up a broker offshore. They're like in Seychelles, St. Lucia, South Africa, Cyprus, a bunch of different areas. And if you go to the About Me or About section, or the bottom of any of these offshore brokers that your favorite guru is actually promoting, just go to the bottom of the page or the About section and look where this broker is actually located. If it's any of these weird places, those are offshore unregulated B-book brokers. And what does B-book broker mean? It essentially means, as you can see here, if you deposit money onto a broker, typically you think, okay, I just deposited $10,000 on this account. Now I have $10,000 to trade with. I can see it in my account. It says $10,000 balance. I'm ready to trade and start earning some money. But the funny thing is, when you deposit on these brokers, one, they don't ask you for any information. You give them your name, your email, deposit the money, boom, I'm ready to trade live, okay? Now what happens on B-book broker, and what that means is that company, that broker, didn't actually treat that as a deposit. They treated it as revenue for the company. Offshore B-book brokers have figured out that, which is a smart play, that most traders are gonna lose money anyways. So why even take the trades live? Why not just give these people a demo account masked as a real account and just tell them that they're trading a real account? When reality is, we are just gonna give them a demo, pocket that deposit as revenue for the company, hold a reserve over here just in case some people are profitable that we can maybe pay out a few times just to make it look legit. And that's how this game actually operates. And it's simply just by looking at where these brokers are located. And this is what every single trader in Miami, all the big traders that are driving $5 million supercars, this is exactly the framework that they're using. Yes, they make money on selling courses as well, but this is where the real cash is. TradeLocker, again, I actually do like TradeLocker. I use TradeLocker on E8 Markets. It's a cool platform. Problem is, it's also part of this, and you can actually be affiliated on these CFD brokers. A lot of them have started using TradeLocker instead of MT5. So both of these are extreme red flags for traders who are promoting them from offshore B-book brokers. The real problem is influencer manipulation. Now, if you have access and you're the owner of this broker and you have access to the back end of MT5, or you can even rent an MT5 platform, you can fake your deposit, fake your withdrawals, you can put any balance on any account you want, you can tell any story that you want saying, hey, I'm gonna take a challenge and turn $100 into $1 million. And I'm gonna do it live in front of everybody for just to see. But I'm not gonna tell you which broker it is, but it's this secret broker I use on MT5. Do you get where I'm saying? It's all fake manipulated stories to fabricate an inspirational story to get people influenced to, one, deposit money on this fake ass B-book broker, and tell a really cool story that this trader is now a very good educational man and can teach you how to do this himself. All you gotta do is deposit money on his broker or affiliate broker and buy his course, all done by a fake ass story with manipulated trades behind the scenes. So that is how you spot a fake trader within 60 seconds. Are they trading on MT5 or TradeLocker? Check where that broker is located, see if they're affiliated. 60 seconds, you know if that trader is real or not. And guess what? They're not gonna show you inside of the account. This is January 1st through March, made $109,000 on my Blowfin account, 79% win rate. On this account right here, 89% win rate. I had to take the challenge first, made $60,000 in the challenge. Then I officially got funded at March 1st. It's now March 25th, 89% win rate. I am now eligible, about to get a $23,000 payout. Slow and steady wins the race. I'm not the best trader in the world at all, but I can show you how to make money with a framework. And I can show you the reality of what trading is. And I can show you how to spot a fake trader trading on MT5 on B-book offshore brokers who earn CPA or actually own that broker, and they can fake any trade and manipulate any story that they want. If you want to know more about my 1 day per week swing trading method using the Quantum Cipher framework, of which I've been using for 21 years, make money, higher win rates, less stress, do it location independently from anywhere in the world, there's a free video below if you want to watch some more of that. Anyways, that's a wrap for today's video. Hopefully you guys learned something. Hopefully that was insightful. Hopefully you have a little bit better understanding of how to get started and also how to choose people to learn from. See you in the next one.